Hello students and welcome to this explanation on general loans. I want us to look at this question called the Chocolate Limited, or for short Choco. Choco, is that the right one? Yes, Choco. So they say it is the largest manufacturer of chocolate in South Africa and it is situated in Cape Town. They have a financial year end on 28 February. Then they explain in the next two paragraphs, they explain that they have a large plant and that they are producing chocolate, that it is a very lucrative business. And then they also explain the process of the cocoa beans that arrive at the plant, and then they are sorted and weighed and roasted. And then some of them are cracked. So you can go and look through these two paragraphs, but basically they just explain the business of Choco. In the next part, they say to make cocoa powder, half of the cocoa liqueur is then slammed by a giant press, and what's left is very dry and can be grounded into cocoa. Then the other half is added to the chocolate, producing along with some of the other ingredients. And the machine mixes, mashes, and swirls the ingredients, which can now be made into chocolate. Then they give you a breakdown of their plant, and they say that they have a building and they also have a crusher. And this is now where the important part comes in. In the first note, you are told that the building was first acquired on 1 March 2007 and that it has 3 separate wings. The largest wings is for the plant. Then there is a second wing, which is the administrative wing. And then there is a third wing, which is rented out. So 60% is the plant, 25% the admin, and then 15% is the rented out portion. So this is quite an interesting question, and you are required to understand in this question that 60 plus 25 gives you 85% of this building is used as PPE, and therefore you will account for it as PPE as a whole, and you will not split it into PPE and investment property. You will recall that I recorded slides on which I explained that we need to decide if we have a building and there are certain floors, for example, that are rented out and certain floors that are used as PPE. We need to go and find out, but what is the majority? And the majority is the classification. So we do not split. If it's a single building, we will not partly have it be PPE and partly have it be investment property. It needs to be one of the two. And since majority percentage is used as PPE, it will be classified as PPE only. Then they say that the third wing is rented out and the rental income for the 2016 year was 300,000 and for the 2017 year it was 330,000. The cost of the land on which the building is situated is considered to be immaterial and the full cost is allocated to the building. 15% is regarded as an insignificant portion of the building. The building is carried on the revaluation model and revaluations occur at year end through the elimination method. Right, so they did not have to tell you that the 15% is insignificant. Following the rule of looking at the use in terms of what it is better and most used for is important. Right, then they've given you the fair values on 28 February 2015, 16 and 17. Very interesting. In note number 2, you are told that on 1 January 2015, it was decided to construct a new upgraded crusher. Construction commenced on 1 February 2015. So this is a very important date because this is the date on which our capitalization period starts. The new crusher was ready for use on 1 February 2017 and the estimated useful life is 15 years with no residual value. Construction was completed on 15 December and installation and testing was done during January. Choco obtained general loans from the bank for the purpose of constructing this new crusher. And they have obtained two loans. They have a general loan A, which they got on 1 January 2015. That is a loan that was worth 1 million rand, and it carries a rate of 9%. And then they have a general loan which they obtained on 1 February 2015, and the loan amount is then 850,000, and the 10% interest is due on it. They say interest on both loans will be payable as incurred. So this is very important information. So we pay the interest as we go along. A savings account was opened to ensure that Choco can earn interest on the loan, and that have not yet for the amounts that have not yet been paid to the contractor. The interest income that is earned is 4% simple interest per year. Then they've given you the progress payments. There are progress payments on 1 February and 1 July of 2015. On 1 March of 2016, 30 November, and 31st of January 2017. In the required part, they ask you to refer to Note 1 and indicate the general journal entries for the building for the year ended 28 February 2017. And they also ask you in required number 2 to refer to Note 2 and complete the general journal entries as it applies to the financial years 28 February 2015 as well as 2016. Please round all figures to 2 decimal places. All right, wonderful. So we're going to start with required number 1. And in required number 1, we need to go and see what journal entries would we do for this building. So this building is classified as PPE, and we are in 2017. So our opening amount would have been this 2,450,000, right? And then we need to adjust it in the current year to be 3,460,000. So the first thing we need to do is go and count the age of this asset, because the building has a useful life of 20 years, and we need to determine what is the portion of the life that has the useful life that has already been used, and what is the remaining useful life. So to do that, we will use the purchase date 1 March 2007 and count the months. So if we count the months, we're going to start with the date that we acquired it, and that was 1 March 2007. So we will have 28 February 2008. We will have 28 February 2009. 28 February 2010. 28 February 2011. Then also 2012, 2013, 28 February 2014, also 2015. Then we are on 28 February 2016, and this is our opening amount, which is the total time that is already passed by the time that we reach our opening value for PPE. So between 1 March 2007 and 28 February, there were 12 months. Then to 2009 was another 12 months. To 2010 was another 12 months. To 11 is another 12 months. To 2012 is another 12 months. To 2013 is another 12 months. To 2014 is another 12 months. To 2015 is another 12 months. And to 2016 is another 12 months. So if we add up all the months that have now passed, we get 108 months that have passed. So at this stage, if we look at the remaining life, we're going to say, but the useful life in total is given to us as 20 years. So if you say 20 years times 12 months, you should get to 240 months in total. So I will say it's 240 months minus the 108. That gives us the remaining life. And the remaining life is then 132 months remaining. All right, and we are doing calculations for 28 February 2017. So I'm going to start by calculating the depreciation for the current year. And we are going to say the depreciation is measured on 28 February 2017. And in order to calculate it, I'm going to start with my opening balance. And the opening balance of what the asset was revaluated to is 2450,000. In order to calculate my depreciation, I'm going to take that amount, which is a total of 24. Let me just make sure that I copy it correctly. 2450,000. And then we have our months that remain on this date at the beginning of the year. And that was 132 months. Right, and we should account for another 12 months between February 2016 and then to get to 28 February 2017, there's another 12 months that we account for. In order to calculate my depreciation, I'm then going to say depreciation will be the 245. They don't say that there is a residual value for this asset as it is PPE. So we're simply going to take the 2450,000 divided by 132 months times it by 12. And if I do that calculation, I get 222,727,27, and I'm just going to round it to 2 decimals as per the instruction. Right, so I'm going to say I debit depreciation and I credit accumulated depreciation on the building. And here I'm going to use these amount, the amount that I just calculated, which is the 222,727. This would be the debit, this would be the credit. And this is my calculation that I'm just going to put in a block. Alright, so now we've calculated the depreciation. Now we need to go and revaluate this asset, and it needs to be revaluated to 3,460,000. So the first thing I need to do is I need to go and eliminate the accumulated depreciation. And the only accumulated depreciation I will have on this asset is the 222,727, because when they accounted for this revaluated amount at the end of last year, they would have removed all the accumulated depreciation. So I only have the current depreciation that I have calculated. So I'm going to take the accumulated depreciation, and then I'm going to play it off against the building, which is the 2227 amount. And then we need to go and calculate the revaluation surplus. In order to do that, I need to go and see, but what is the carry value of this asset? So I have the cost. So currently the cost will be the last recent revaluation, and that would be this opening revaluation of 2,450,000. And the accumulated depreciation will be the depreciation we just calculated. So therefore, we have a carry value on this asset, which is the difference between the cost and accumulated depreciation. And that leaves us with 222,727,73. Then what is the net replacement value on 28 February 2017. It's given to us as 3460,000. So what is the difference then? It's a revaluation surplus because the net replacement value is higher than the carry amount. And the difference between the two is 1232727,27. Too many 27s. Holy moly. Just want to check it did divide by 132. Yes. Right, so this is our surplus. I'm just going to put now this calculation into a journal format as is required. And therefore I'm going to say debit the building, credit the revaluation surplus. And we've just accounted for that amount. Right, so then there's one last thing we have to record and not forget about, and that is our rental that we have received. They say for the 2017 year, we received rental. The rental was 330,000. So they don't say whether it's been paid, so I'm just going to assume that it was paid for in cash. So the entry will be bank and rental income. It will also be correct if you refer to this as debtors. And the amount given was 330,000. So that is the final journal entry that we will do for this building as it relates to note number 1. So this is quite an interesting question. We need to remember that the new cost price is whatever it was previously revaluated to in terms of the net replacement value. All right, moving on to